Okay. All right. Good morning. Good afternoon, everyone. It's me, Guillaume, and here with Rosalie, aka the Crypto Queen. This is Stop Losing, Start Trading, the weekly trading, the trading show we do 3 times a week about how to be a better options trader. Rosalie comes in with a background in meme coin investments. I don't know how much money you can make in investing in meme coins, but now we are converting her to be an options trader. We use Panoptic, but this content can be applicable to any options. Everything we say here is not financial advice, of course, but you can use this as a way to understand a bit how we think, how we view options as a way to be a better trader. Title of this episode is also why trade perps when trade options. This is also something that we can cover on. But yeah, first of all, Rosie, how are you doing today?
Good, good. Yeah, I'm doing well. It was raining earlier, but now it's sunny in New York. So yeah, I'm glad it's Friday, and I'm really curious about the positions already.
Yeah. So we discuss these trades, which is kind of extract Rosalie's instincts and try to discuss a trade for it. And then intern.panoptic.eth is trading, and they've been doing very, very well. When intern is left without guidance, so Rosalie was traveling. This is something that the anyone can be faced with. We had to do some hedging trades. We had to prepare. Now we're back in it. They put on a few trades over the past few days, which is going to be interesting. But yeah, and the markets have been kind of sideways. ETH is going, yeah, up, or at least not down anymore, which is great. But it seems like it's maintaining quite well. Last few days, few hours, we see Bitcoin going down. Oh, the Steve Wynn, or the whale trader, got liquidated. I don't know if you were watching that.
No, what happened?
Yeah, some meme coin will, or some way that started with Pepe, I think, but they were trading. It's all public, so they were trading on Hyperliquid, and they had a huge position, like I think $1 billion worth of notional. I think when Brendan we do the option hour, he probably have maybe some numbers, but it's a huge trade, and he was going long Bitcoin and then short Bitcoin and long, and it kind of highlighted some the trading of these whales is not unlike what you see at the small wallet level. They followed the trend and they got liquidated, which is kind of course, something you want to avoid. But they got liquidated and lost, I think, 100 million, or at least a bunch of his PNL got wiped out because the Bitcoin price went down. As you see, the price we did go down a little bit overnight. So how do you you don't trade perps, but you trade meme coins? Are you prone to these kind of maybe selling, buying back, trying to hedge, trying to trade or overtrade yourself?
No, not at all. I'm really bad at that. I always just like hold. If I'm lucky, I sell. But I won't sell at a loss. And so I just end up holding, and then like I lose all the money, and I'm like, well, it's already gone now. It doesn't matter. But yeah, so I wanted to ask about that a little bit later on as well. But yeah.
About what? About not
Yeah,
what?
like what you should do. I mean, once the price has gone down, you've already lost the money. But is there anything else that you can kind of do at that point with
Yeah, I
options?
think the main factor for why traders may be accumulating losses and now they're stuck in, oh, it's worth 10% of what it was, is because there's no time scale. If you buy something, could be till you retire, decades in the future. In that case, you don't mind going up and down, and maybe you dollar cost average and keep buying and buying. And if it's ETH or if S&P 500, or you want to go even like ETFs, this is how you do investment. Nothing will phase you because you have a very long instinct. With meme coins, even with NFTs, it's such a new asset class that it's hard to know if they're going to be around for the next 3 months. So that might be where the time scale is what's missing. Uh, you want to hold it for a day or a week or a month?
Yeah,
This
you
would
should.
change.
Yeah, you should have like a time in mind and then watch it for that time. But it's also, very time consuming to always watch these meme coins. Sometimes they're only around for a little bit, and so
And
yeah.
and most of for now, the whole Pump.Fun and launcher means that the whole cycle gets compressed in like a few hours or a few days, where you can be the one at the top, you buy the top, and then 2 hours later it's at the bottom. So that's
Yeah.
why I stay clear from meme coins, meme coin options. Providing equity on meme coins, you harvest that volatility, so you can imagine that you can ride that wave up and down, getting back to where you started, but also having some fees generated if it's a Uniswap or a mem position on a option protocol like Panoptic. Same thing in TradFi. And the being stuck with a token or a asset that you don't want to sell, you can sell call against it. You can actually generate yield. You can program an exit point any time to exit, which is not something you can do with a limit order. Typically, with TradFi options, you have an expiry and a fixed premium. So, say if GameStop GME goes back to $150, I sell, and this is that happens within a week. I sell. If not, I can keep rolling. So, options as a way to gracefully exit a losing position is also something that a lot of people do. And maybe we did some trades in meme coin. So again, maybe it might be worth going to the portfolio. I'll go to the ETH price. So ETH is pretty stable, up and down, but pretty stable. That means that most of the action we'll see on ETH USDC will be stable, but maybe the meme coins now will have some lower beta. We'll probably see some interesting aspects of it. So ETH price 2600. I like this price. Definitely kind of stable, and I'm going to be drilling this down. A lot of the times, you don't want to get caught in these extremely sudden moves, but afterwards, you can kind of anticipate some level of calmness, and this is going on for like 3 weeks already. So I might be tempted to now scale back, and anything 3 weeks, 4 weeks is an eternity in DeFi and or crypto. You may expect a price move, so I would also kind of maybe lean into it. And again, the volatility may go down, and the options that you can buy can be cheap. So yeah, let's go to the interns portfolio, which was uh, is a bit more full than we had last time. Up $20 on the portfolio PNL. Several positions. I think there's one position in each market. Yes. So is there one that you want to maybe start with? We have
Um,
Bitcoin, ticker Bitcoin, ETH, Eigen. Which one do you want to look at first?
Definitely want to start with USDC.
Yeah. Okay. So this one seems to be losing $56. This is one of those that has multiple positions, two somewhat bullish positions, which is this call option that's been purchased, I guess, a day and a half ago. Put options being sold as well 10 days ago, and the call spread. So they all combined. Seems that the option we purchased is definitely the biggest loser. So this is one of the, and it's fine, I guess, nothing to worry about. But we purchased a call option. We wanted to be bullish on the price. Might have sold the top near 2,700, but if it's a bullish trade, price goes back down. Nothing concerning. It's going down maybe like 5%, but it is contributing to some losses. It's fine. We see $85 of losses. Out of that, only six is premium. So that means that we are pretty much holding almost one ETH, but for free, we pay a little bit per day, but it's not major. So if it were a perp, you would see a price going down one to one with the asset price going down. Here we have this protection on the downside. So overall, this is not something to be worried about, because I think unless you change your assumption, are you still bullish on ETH? Now it is 2,600, and when we started it was 2,700.
Um, I don't know. I hope so. It needs to go like at least to $3,000 sometime soon. So I'm not sure when that's happening, but I know it will.
Within 1 to 3 months, maybe, or within 1 to 3 years. You know.
One, two, three months, not years.
Yeah. And this is fine. This is 2 days into it. Price will move. You have to have the option to work for you in a way and be patient. And again, the SEC is having meetings with crypto. There's the Genius Act that is stable coins, but there's a Clarity Act, I think, that people haven't seen, that will help with DeFi. So I do think that most crypto or digital assets will likely go up, unless there's a macro tweet storm that means everything is going down. Crypto now is in a pretty good place. It's been crushed over the past 3 6 months. Now it's more likely to go up and down. So yeah, I would say that it's also fine. Maybe we lose $85, but again, you control $2,200, $2,300 with some amount, with a small amount of collateral. So it's a leverage bet, but again, as long as you're not we're not going and visiting the 1800 or less. We're not. I'm not worried. It's still kind of a high delta trade. This is one trade that was created. In the portfolio, there's also another trade which is bullish, and this one is making money. We can have a look. So the price of entry, this was 10 days ago, means that you can have multiple bets happening at different time scales, but some of them may be positive, some of them may be negative. But yeah, this is a put option. And then, yeah, can you go and walk us through what we see here, and if there's anything that concerns you?
Yeah. Okay. So we're still in range, and we're selling this option, so we're earning some fees. Yeah, we have a little bit of a spread there, so that's looking good. It's hard to tell. Maybe we're like halfway through the slope that we're interested in before it kind of goes to zero, and so there's still a little bit more fees we can collect in the meantime, but
Yeah,
I
I mean,
wouldn't.
I think this is also a perfectly fine option. The there's a slight rendering bug, but yeah, the being in range is what you want to look for, and we're in range. We're earning fees. This is fine. We're getting paid a little bit. There's another one, someone else on the buy side. Oh, it's yourself, so you pay yourself. Is it?
Really?
Oh, it's the same one. Yeah. So you buy and sell a put, buy a call.
I
Interesting.
was thinking that might happen on Wednesday when we were doing the trades. I didn't want to say anything. That's so funny.
So this is a very we sell a bit less, but yeah, this is a very bullish trade. Selling a put, buying a call, and yeah, the slope, or at some point you'll get to diminishing returns, where here you benefit a lot from that price appreciation. The slope is straight. Here it's flatter. Can still be in range, but there's a much less of a delta, much less of a slope, and here it's out of range. So here if it's getting to a point where there's no more slope to it but still earning fees, this is still fine. You're just kind of less exposed to risks, because if it goes down now, it goes down by quite a bit. So this is 10 days into a monthly option. You're earning $17, so more than half of your profit comes from that stream. Yeah, so it's working as intended. Yes, price did go up, but what we're interested in is having kind of fees collected. So yeah, this one's good.
Good.
And the last one, I think, was in a weird way a bearish trade, and this was because maybe to compensate for
Hmm.
the other one that was long. And we've seen these call spreads, but yeah, what do you see here?
Okay. Yeah. So we're still in range as well, but I'm wondering, are we earning or are we paying? Which one is in range?
Yeah, so we have a wide option. So we bought a monthly call way above the current price, and we sold a weekly call pretty much at the money. So we are taking wide liquidity and concentrating it and bringing it closer to price. So both options are in range.
Okay.
So we pay on the call side and get paid on the sell side. But because we concentrate, the net funding, if you want, the net spread is positive 0.29. So you earn less than Uniswap. The corner one is that you have less risks, and the fact that it's still in range after that time, it's fine. We've been going up all the time, which is what we want to see. So yeah, it's one of this is a calendar spread. We buy even a diagonal, buy a wide option, sell a narrow one, and yeah, uh, this is kind of it kind of works the way we expect. So has it moved? It moved a little bit, but it's not kind of out of the ordinary. If it were to go way up, then again we have these other bullish trades that can maybe can nullify some of that. So yeah, I think it's actually pretty fine.
So some of our trades, yeah, we'll check in on Monday, but they can't all be winners since they're
No, that's right.
opposed.
One is bearish, two are bullish. The entry point defines your net win or lose, but in that case, um, yeah, we can look at the portfolio. It's always more insightful to look at the whole portfolio P&L, not just one trade, but rather all three together, including your deposits. This is what the P&L chart looks like.
Okay.
But in reality, you also have deposits. So you can go to that menu here and include deposits. And now it's pretty bullish because we have some ETH deposited. So we have 0.58 ETH. This earns APY in terms of yield, but at the same time appreciates in value as the price goes up. So if we were to see price keep going up, then you would be earning a lot on that, both bullish position, but also that ETH deposits.
All right.
Um,
Yeah. Hopefully we have a good weekend.
yeah, and it's none of them are near kind of the in time scale. 1 week, 10 days, 2 days in, it's fine to see some transient losses because the premium hasn't accumulated. But yeah, as we keep going, you have 20 more days to go. So we can imagine that these will keep accumulating. One thing that's also useful is the risk analysis tab, which is how do we get liquidated? When do we get liquidated? The UI now shows no crossing points, so this is pretty safe. Zero risk of liquidations.
Good. Good.
Uh, yeah, so we're currently at 32% buying power, margin utilization. It's a good spot to be in. You don't want to overextend. Again, if you have 100%, you get liquidated. Now 30% is where we have discussion. We could open one or two trades even still, but I would say let's wait. Sometimes the weekends are a bit crazy, so we can wait on Monday. But there
Okay.
could be a space for one extra trade
Yeah,
on that.
I would like to see like a strangle in here as well, but yeah, we can do that on Monday.
Okay. All right. So let's go to the portfolio. I think you wanted to create a BTC one.
Mm-hmm.
Speaking of strangles, there's one here, and it's in the green. So let's have a look. Right. So ETH BTC, we have the ratio. Uh, the way it was constructed, it's a delta neutral trade straddle, but the price was a bit off. But yeah, what do you see here? How do you interpret this data?
Cool. Yeah, it looks good. Both legs are in range, and we're getting paid extra fees there, so that looks really like a
Yeah,
good
six
juicy
six
spread.
percent more than the Uniswap fees. Yeah.
And yeah, those numbers. I don't understand those numbers. The
Oh my god.
crazy fractions or decimal points.
Sorry, there's a rendering. I'll look into it. There's a weird thing that happens. Now it's fine. Okay. Yeah, so it's a straddle. Is it bullish, bearish, or neutral given the current payoff here?
Um, it was bullish, right?
So
Bullish
if the
and
price were to go up on this side, like is it more green or more red? And that's kind of maybe the best way.
red. Yeah. So
It's a bit bearish. Yeah, because the max profit is below the current price. And we can see the price, we kind of minted it near the top. So again, we're a little bit right in the sense that the current price is below the starting price. But yeah, this maybe has a target of 0.023 ETH to BTC when it's 0.025 now. So yeah.
I mean, yeah, I think if ETH does, you know, do well over the weekend for some reason, Bitcoin will probably shoot for a store like right after anyways. So I'm not like
Yeah, the ratio, it's a very
yeah.
interesting trade, very unique for sure. And the big moves we see, if they are broad market, then the ratio doesn't move. So that's kind of one thing that got it working for us when we use these straddles. But yeah, and so this is BTC. I think there was one position on BTC USDC, so the real price. And let me have a quick look. And then I think that's it. The Eigen and Ticker Bitcoin are doing well. This is another trade opened by intern. Price of Bitcoin. BTC USDC, and I think this one was probably not something we discussed, but then given that you are you, this is a bullish trade on Bitcoin, and then we minted it when the price was 107, so maybe near the top. But this one will be making us money in premium if it's between 79,000 and 125,000. So this is one trade where we capitalize maybe on a little bit more of that premium being collected and some slight appreciation if it goes, and then still within that maybe 79K range within a day, a month. Um,
That looks
and
good. Yeah, I don't think anything drastic is going to happen to go below that. But yeah, well, how long has it been? Oh, just one day. Yeah. So
exactly. So we lost, but that's because the price moved. That we were earning premium, and it's one of those things. We typically think in terms of strike or price now, price in the future. But the range is also a good predictor because you can also be range bound in your price targets if you want. So if you have a absolute floor, for some reason you're convinced that it's never going to go below 80K again, then that shifts and that could create strategies that are uniquely shaped around that, which is different. The floor price is different than the target price. You say,
mhm,
yes, it may go above or below, but the floor price is never breachable. So that is a type of assumption that is also easier to kind of realize in option space than just perps.
very
Yeah.
interesting. Yeah, looks good. I'm glad these positions are all new. It's not looking negative like last time we checked.
Yeah, and then the few losses, few wins again, maybe in US dollars. Win big on Eigen and Bitcoin, lose a little bit on USDC, but all of our pairs are crypto focused. So if the whole market goes up, Eigen will go in value, ETH goes up in value, ticker Bitcoin goes up in value. So all of this kind of contributes to your positive P&L. So you are exposed to multiple markets, but this is where you diversify your holdings, but also diversify the strategies within these markets too. So it can be neutral, again, bullish ticker Bitcoin, for instance, and then the price appreciation will kind of move both in the same way.
And I'm just paying myself as well, so I'm glad the premium is not going to somebody else, but it's just going directly to intern.
Exactly. And yeah, there we go. Intern is earning points as well. Don't forget about this. We have oh yeah, we can look at the leaderboard. Um, oh yeah, we have the competition, but the we can talk about that with Brenda. But the points balance, definitely a bunch of people are have been mining points. Intern is doing pretty well. Again, it's a 10K account, and we're doing pretty active stuff. If you have 10K in deposits and do nothing, you will not get maybe as much points or be ranked 34th. We are being active. We're trading to manage risk, of course, but because we sell options, because we are actively trading, then we climb as much as someone that may have 50K worth of deposits. So this is where you can also, with some of reasonable kind of risk management, you can tap into maybe the points incentives a lot better by being active as opposed to just being passive and not doing anything. So yeah, intern, we've surpassed Ethereum intern.
Good.
The next one might be this lovely trader. But yes, as we keep going, this is where we can actually activate more returns by being active than just kind of holding it there.
I highly doubt that Steve is more active than intern,
No,
but
you may have a larger deposit, and that gives you a baseline, so your deposits earns point. But if you sell or actively optimize for this, then yes, you may earn more. So
I got my next competitor in mind, so it's good to know how much I need to climb.
there we go. There we go. So yeah, this is. I think this is it. Again, unless you have another market or maybe an idea you have in mind.
No, we'll see on Monday. Maybe want to create another ticker Bitcoin position as well, but
All
not.
right. Yeah, you have some. You know the community well, so you probably have some alpha too. Maybe we'll share it Monday. Maybe we'll see it. Yeah, this is great. Thanks a lot. So we'll move on now to Brendan, who's going to be with us for the second half of the section, which is options hour, where we talk about the markets. But yeah, thanks very much, Rosalie. This was great. And then yeah, I'll have Brendan take it away.
Sweet. Well, we are going over some of the best and worst trades of the week. So we will look at some of these option traders and see how they've been doing. We also have some very interesting positions coming out that have been doing well and some that have been doing poorly. Do you want to give a quick recap of anything that has gone on this week in the markets, just to give some context?
I mean, you mean we ended the competition 2 weeks ago? We have been kind of analyzing this very, very closely. Markets have been sideways, so it might be hard to do a very directional bet unless you time it right. It was range bound, so I would imagine that the market being sideways may benefit the sellers a bit more. If you don't move much, you pay more fees on the buy side. So this is kind of the what I see. But yeah, overall, ETH, BTC probably are back to where we were last week. So it's not very an interesting week, I'd say.
Okay, so with that in mind, what do you think was so I guess we'll go over two chains. We'll look at Ethereum, the bigger wells trading, and then we'll look at a chain that we just newly launched on, as you mentioned, which is Base Network, and we'll look at the best and the worst on each chain. So we've got four trades to analyze. What do you think is the best trade then? You mentioned selling options might be.
So maybe the way this works is that this trade had to be opened between 7 days ago and now and closed within that time scale, or something that was just closed within that time? Yeah, can you go over the rules maybe for that?
Yes. So the rules of the game, where we quiz Guillaume to see if he can correctly predict what type of trade is put in. So either a call, a put, did you buy it or sell it, or is it some combination of calls and puts like straddles, strangles, or something more complicated? So the rules are basically we're going to look at the trades that have been opened since last Friday, and they could have been closed at any time in the last 7 days, or maybe they're still open. So then we market to market and see what has been doing the best as of about 2 hours ago when I ran this.
Yeah, because I'm asking because the price action that we saw again, it was 2,600 or 2,550 a week ago. Now it's 2,600, so it's kind of sideways. But there is some activity. So if someone times it right, open a trade near the bottom of the weekly price and sold or closed this near the top, which was 27, almost 2,800, then that would be more likely the best way. So it's not going to be selling a call or buying a put, because we don't see this as much. What I would say best trade is on the selling a put side. Again, back to my intuition about the sellers be a bit more advantaged. But yeah, I would say selling a put might be the best trade that we've seen this week.
Okay, sweet. So do you want to look at Ethereum or Base first?
Let's look at Ethereum. It's always a slightly bigger numbers, but people are a bit more careful, I'd say, than Base. Again, different user base, as you said, maybe whales, maybe more larger funds, so you don't put all your money in one trade. So yes, that might be where we see the short puts.
Okay, so selling a put as the best trade on Ethereum. Let me find the tab here to share. I believe is this one. Let's see how you did. Unfortunately, it is a call option that has done very, very well. Now, this is a option in a larger portfolio because this is a gigantic position. $125,000 worth of options sold here on Panoptic. It's a 40 ETH contract, and I was looking at this. Lots of liquidity available for purchase here. So just sitting here being sold. Side point, why are people selling such huge options on Panoptic when no one has bought up the majority of it? The reason is you actually make premias even if no one's bought your option on Panoptic. Why? Because they're deployed as liquidity positions in Uniswap when no one has purchased them. So they earn trading fees.
Yeah, try to compare this with an order book. Someone may say, I'm going to sell 40 ETH worth of calls. You need the market maker to actually execute that trade. They need to hedge. The bid ask could be very wide where you don't get a favorable exercise price. And maybe you keep it on and then it's time to close. Now the same story. You have to find a market maker. You have to kind of cross that bid ask. Maybe you lose 5% on the way in, losing 5% on the way out. So the whole thing can be extremely inefficient. Whereas on Panoptic, you can open as big as you want and you get paid immediately. And I'm sure from the premium tab, you can see it's been going up to the right the whole time because it's in range and earning fees. So yeah, so short call. I did not expect that for sure. But the entry price again, our face is there. Yeah, near the top. They sold near the top, and then now it's definitely lower than the top, the weekly top. So very, very good trade for sure.
Yes, this is very interesting as far as the premia goes. It's about half of the actual gain in the position value. So about half of the profit comes from the premia that has been realized so far, and the other half has come from call selling calls being a bearish position and the price having gone down, fulfilling that kind of directional assumption. So what is this? I think this is about what 3.75, probably 3.5%
Oh,
in premium earned over 1 week.
and
So
and
quite a
also
lot.
we changed the numbers and the percent a little bit, and this is something that again you may have noticed, but the position size itself is 125,000. So this is quite sizable. But the requirement, the margin requirement for this is 23,000, so about one fifth of that. And technically, this is what you're working with. It's a leverage bet, but you only put aside 24,000 to control a much bigger one. So the profits is in that capital at risk that we now compute. It used to be on the full amount, which was 125K. Now we figured out that for long options and also short options, it makes no sense to use the, and then spreads as well, which was kind of a big headache, but use the capital requirement as to how much money you have at risk. In that case, 1,800 out of 24,000 is kind of 7% in a week, which is kind of the real quote unquote return to capital at risk formula.
Right, makes sense. So this would be about 3.5 of the margin or capital requirement. How does that compare, you think, with a centralized exchange like Deribit as far as the premium goes for
So this is
1 week?
this is a monthly option, and you're 1 week into it. So you can imagine if this were either upfront or a trade, you would like have four times this. So maybe like $3,600 upfront if you were to sell this. So I don't know if it's worth looking, but I would imagine that from that you can extract an IV, you can compare it with a price. I would unfortunately say that it's likely less than what you'd get on Deribit because you are kind of selling on the realized volatility. It's still sizable, but that means that if you're a buyer, some people bought it, but if you buy that call, which is what also Intern has done, you pay much less than what you pay on Deribit. So maybe the flip side is that this user is taking some risk, earning less. They have PLP deposits, so they're earning like risk-free rates on their deposits, but the seller is now kind of not optimally deployed. It's the buyers now that would have a much better expected value outcome because they would buy options cheaply. And even though you don't expect the price to go up, but if it does go up, then it's going to be a very good trade.
Yeah, I guess the spread component here is just barely over 1 because of the 2 ETH that has been purchased out of this 40 ETH contract. So we're seeing just 0.1% additional gains for this option seller from a small slice being purchased as an option on Panoptic. But you can imagine as more people see this gigantic chunk of liquidity at the 31.28 strike, they could be buying call options out further. I guess the price right now of ETH is what, about 25.96. So if you're looking to buy these 3,000 strikes, plenty of liquidity here, and that would bump up the premium.
And if you looked at me at my Twitter feed, I've been pushing this trade. I feel like this is an unappreciated trade in DeFi, but also in traditional finance, which is if you're mostly in stable coins or if you're risk off, you earn maybe an interest rate on your stable coins. Could be treasuries, tokenized treasuries, could be lending protocols, could be anything, but you have just a kind of small return, 7% maybe at the best, expected return on your stable coins. And this is fine. And you can actually be happy with this, but there's a way to hedge on the upside, which is you can buy cheap calls, lower than what you would pay on Deribit, but you buy cheap calls. A little bit amount can go a long way if the price does go up, because if you have stablecoin deposits and the price revisits the 3,000, 3,500 or even higher, you don't see any of that appreciation following to your wallet. But if you have some calls that have been purchased, could be 1 ETH, could be 1%, could be a small amount of your old deposits, then you hedge on the upside. You have one source of revenue that can go 10x, whereas 10x on, I don't know, 10% of your portfolio is still pretty good, and as opposed to 7% over a year. So yeah, that's another trade where, yes, the seller's best trade of the week, I'm very happy with them, but then the buyers could also dip and have this be part of the portfolio for tackling like potential upside moves on the ETH.
Yeah, that's right. I
Yeah.
mean, we're seeing, I think, available liquidity. Does this mean 52.5 ETH is available to
Yes, to
purchase?
buy, and then only 2.5, I guess, or three even were
3,
purchased.
yeah.
So still pretty heavily. There's a call side for, there's a few very good call side trades you can do. Puts is the other way. If you're bullish ETH, then you may not buy puts, but if you're bearish, you can also do this. But yeah, that's a diversification of revenue sources. Again, you don't want to buy perps because perps could wipe you out if it does go down. If you have a call option, it's capped the max loss. So that's kind of the attractiveness of options over perps. Why trade perps and get liquidated on the downside when you have an option that is much less risk, I guess, or no risk of liquidation.
Yeah, and that is the title of today's live stream. Why trade perps? Look at these beautiful options. Their curves are gorgeous, and yes, that is where you get the capped payoff. So you imagine this user has a capped benefit, right? They can't make more than right here 2140 if the price goes down, assuming the Streamia stops accumulating. But on the flip side, if you were to buy up this call option, that's where now you get the capped loss, right? This whole curve just flips over and it becomes a capped loss where you can't lose more than a certain amount. All right. Well, do you have any other comments on this one before we move on to the worst trade on Ethereum?
Let's look at the worst trade. Now, I was expecting maybe a call as well for the worst trade, but then this flipped the script. So this is a well-timed option. They opened it up at the right time if you want. So this is a good place. The losses are rare. Now I'm getting confused, but yeah, the losses are mostly like maybe long trades or trades that were left off, and it's like very directional, but then you kind of miss out. So the same trade could have happened where you opened the call and the price went up. I would say let me be spicy. Another call selling is the worst trade.
Okay, call selling, yeah, because it just depends on when you entered. I think
yes, and we did see quite a not violent, but the most momentum was on the downside from that high. So yes.
All right. Well, this will be a tough one for you to guess, so I didn't expect you to guess it correctly. So here is the worst trade on Ethereum right now. It's a 3-legged option where the puts kind of cancel out in a way. I think there must be a name for this because you got a short
put. Ratio spread.
Okay, ratio spread. So is this what? Yeah, can you explain what a ratio spread is? I think there's different types of ratio spread. What kind of ratio spread is this?
Yes.
And what's the purpose?
So a straddle will normally be the put and the call, which is on the right-hand side. Seller put, seller call, the same straight. This is very bullish. So the target price is 3,300. That user probably had bullish take. It's bullish in design, but the price went down. That's why they lost. But that on its own is a straddle. We traded them with in turn. It's twice the capital efficiency. You earn when it's in range, and it is still in range, so technically they're earning fees. And what I think is happening here is that they saw a lot of liquidity on the put side, or at least if we were to click on that put, there's likely a lot of liquidity, and the spread is kind of small. So that account bought some protection on the downside. So this, if you zoom out, this limits your max loss. If it's a bullish trade, it's fine if it works for you. But if it doesn't work, you have some protection on the downside, which is again still 12 or 1400 max loss. But if you were to go to 2000 overnight with a pure naked straddle, you would lose quite a bit more. So I would say that this is, and it's a day and a half ago. So it's slightly badly timed because price went down. But it's one of those trades where it's bullish, but then because the trader was probably worried about the downside, they bought some protection. So it's not like a put spread, which normally is two legs. Now it's a put spread and an extra call. You can think of it as the user, and if you click on the call, you can look at it. Yeah, the user thinks the price will likely stay between 2,000 and 4,000, or I mean, no, 2,500 and 4,500, I guess. So the 4,000. So they think it's still going to be range bound. But if by some off chance they are wrong, which is almost about to happen, I guess it's out of range, then they are now protected. Whereas if they did not have this put, they would be losing 1-1. Yeah. So the ratio spreads is, you see them often. It's a lot of it is arbitrage, less kind of smoothing the volatility surface curve. If you do it in TradFi, you're effectively kind of moving liquidity, a little bit of liquidity out of the strike you buy to the strike you sell, so you can have this kind of be a equilibration trade. But yeah, it's a little bit more similar than a naked call, but you have maybe some more kind of fee or theta when it's in range. So I don't know if the price is going to go back up, but that option, being a day into it, I would not manage it very quickly. But if it keeps going down, now you'll be paying fees. You will be subject to this. That might be where you again, the bullish trade turning bearish is where you lose. But yeah, so 5% in a day, that doesn't look good maybe, but if it were to go back up, it could be 5% in 2 days. So that's one of those things where it's hard to know. And again, controlling about $40,000 worth of capital, only requiring 7,000. So it's actually a very, very capital efficient trade. It's just that it's directionally wrong, and that's kind of it. Which is again short call ish in nature, maybe. But yeah, it's a call ratio spread.
But the way you explain this, I think, is very interesting about how, this is a bit of a bullish direction. So they're thinking the price is going to stay between 2,500 and 4,000, but probably go up and hit this max point. But if they're wrong, in the scenario that they're wrong, they do have that protection where they would lose less than they would had they not bought that protection. I think that's illustrated by the short straddle that would normally be a bit steeper going down. But here it's actually a little bit flatter and then completely flat after that. So is that kind of the idea, is that if you're right, then you do well. If you're wrong, you do poorly still, but just not as bad as you would with the straddle.
Yeah, exactly. And then the trade-off is that, again, the numbers, it used to be you would earn the fees on Uniswap. Now because you buy, you earn less than that. So that's kind of a trade-off. You buy tail risk protection at the detriment of some less fees. But yeah, this is kind of and then if you zoom out, the perps, again, I don't want to dunk on perps too much, but it's very linear. It's very, very black and white. If you were to trade a perp there, you make money, you lose money. It goes up 10%, you make 10%, it goes down 10%. So this is a slightly more complex trade. There's a lot of subtlety and nuances to it, but it is something you can trade. This is where you can shape exactly the payoff or the risk profile that you want. And you buy some protection, you sell with capital efficient deployment. You are in control a lot more than perps, which is extremely directional. And if it goes wrong, you can actually be liquidated. Whereas here, there's no liquidation risk on the downside. The only risk that account has is like on the upside. And it's only if the price shoots to 6,000 very quickly, for instance, that they would likely be liquidated. So it's like a much more of a gray zone to it. Again, the being directional, but then managing risk is the beauty of options. In that case, it seems to be one of those examples.
And tell me if I'm understanding this right. It looks like the delta here is about 3 ETH at the current price, which this is a 6 ETH contract. So if this was, a perp, wouldn't the delta be about twice as much, 6 ETH, where you would be losing twice as much if the price went down?
Yeah, exactly. So the delta is the exposure you have, and as you say, it's 3 ETH. It combines some of that kind of the put that you buy changes this, but yeah, you if you were to buy 6 ETH outright, which is what maybe we'll be doing, then yes, you have twice the risk as well. So and if you were to go down to 2,000, you have zero delta, so you have no risk, and it's again you don't want to stay there for long. But if you do think it's bound to revert back, you could still keep this open. But yeah, the slope, the risk is also how much sensitivity you have to price moves. In that case, it needs to be half of just holding the naked positions.
All right. Well, thanks for covering this very interesting ratio. What is it called? A ratio spread? I think you call
No,
it.
and then I think about it, it's a reverse big lizard. Ratio spreads would be all puts, or all calls in that case, which is only like the one buying one call, sending two calls. Here it's puts and calls, it's straddle. If you buy both sides, it's a iron butterfly. If it's one side, it's a reverse big lizard.
So a
But yes,
lizard is just a butterfly missing a leg or a
yeah,
wing.
this, and I don't want to go into it, but you have broken wing butterflies, we have offsets. There's a lot of things, and sometimes these trades, when it's a butterfly or like an iron butterfly, iron condors, these are not hedging, but they're again taking advantage of some inefficiencies. But you want to manage them so that they are free in a way. You are able to manage the positions. You are able to collect more premium, so that regardless of the price, in that case, you can imagine if the price were to go up, if the fees were to go up, you can see all green on the left hand side, and that would be no risk on the downside in a way. So these defined risk is not just for limiting risk, but you want to transform this through kind of careful management into a risk free trade sometimes. Well, you lose
Okay.
by what?
Well, very cool. It's always fun when the animals show up on our best and worst trades. It's
Yes.
a unique phenomenon. So, all right. Well, thanks for explaining that trade and some advice there for the reverse big lizard
Yes.
owner. So we'll jump to quickly two more trades here on base. We're going to look at the best and worst trades on base. These are smaller positions. Gas fees are cheaper. People can go in, go out quicker.
Yeah, I wouldn't expect to see reverse big lizards. Or maybe two. So, but yeah, other trade was definitely for someone that had a good understanding of everything. But yes, the I maybe I'll be also punting it. But yeah, a short call would be the biggest winner as well, and then a short call would be the biggest loser as well. I think we'll see a similar trend.
All right, sweet. Well, let's start with the. We'll go with the biggest loser this time to switch it up. I think it's this one. So this is on base, and you nailed it. So you are correct. This is a Sorry, you're correct on one of the.
Yes.
It's
No.
basically a short put. Sorry, my bad. I
Yeah.
saw a
Exactly.
call and I mixed it up. So they bought one call option and they sold two put options. Essentially, does this translate basically to almost like almost? Yeah, I don't know what kind of a strategy would this be?
I don't know. I don't think it has a name. This is a bullish. Buying a call, sending a put is a synthetic long or a perp, and that's fine. But they sold two puts, so they definitely have. If you look at the slope, there is less. The slope is less on the way up than it is on the way down. So they are more bullish maybe than just a perp, because the risk on the downside means that they don't think they're going to visit our extreme company is going to go up. So they doubled it on the fees, and if they're right, they will make money. But then they make twice as much on the fees because they have two puts. But yeah, I would say that it's a trade where the call is paying more too. So yeah, it's an interesting trade. Without saying yeah, if it's losing, and then it is definitely because it was directional and directionally wrong. But yeah, we don't have a name for that. Yeah, we can call this the the nickel collar. Yeah, maybe not. That's why we have Aaron. We could have a nickel. I don't know if Nickel Alchemist is listening, but the ore qualifying the trade.
Interesting. So why purchase this call leg instead of just selling
Oh, I
some
think
put?
the way that made this happen is that they saw the put option payoffs caps the upside. Regardless of how many you sell, you don't see any gains past your range, and it's flat. Here, you add a call, could have been offset or differently, but that call now restores that profit. And because they sell two legs on the put, on the buy one leg on the call, they are getting paid. The next net premium is still 0.18, but still positive. And yeah, and then because of that, they are able to earn fees, but also get exposure to the upside. And Brendan logged off. I think he's back. There we go.
Yep, sorry about that. Okay. So yeah, very interesting. So you buy the call to get the upside exposure. You sell another put to basically fund the call, and then you still have so you still have your short put that's earning some premium, the original leg, but then you get the added bonus of the upside
Yeah.
exposure. The
So
cost is you're paying a little bit more premium on the call leg than the put leg, just because that's a more popular option. It looks like.
and so the funding one leg, wedge selling another leg is very very common in traditional options. You can buy, and I don't know if the audience knows, but you can subscribe to the Paradigms OTC desk, which is over the counter options trade. You can see what's being executed. Bitcoin trades quite a bit there, some Ethereum, some Solana, but a lot of the trades we see is not just pure buying. You can be bullish, you buy a call, and people don't like that because it's expensive. And what they do is that they buy a call but sell another call higher. So they fund the call purchase with selling another option. The trade-off that you cap your max profit, but you limit your losses as well. You get paid on this. So it's a single transaction where you sell and buy all within one transaction, and then that reduces your cost basis. Here, if we do the same trade on Panoptic, you have to look at the multiplier. So every block, you still want to have a positive or maybe a less negative, but that's where the funding comes from. Is currently the spread is 0.18, which is positive. And I think if you look at the premium, it seems to have been maybe negative a little bit in the past. So you are buying a call option expected to see some negative. Maybe zoom in a little bit, but yeah, some negative funding rate. But because you sell an option, you fund, or at least you reduce that funding rate. So we haven't explored this too much, but the calendar spreads trades that we've done on the on Rosalie's intern is one of those where you buy a large one, wide one, sell a narrow one. That trade-off means that you pay on this on the buy side, but you pay less per block than what you get. So that's getting funded for doing something is where we can also imagine this happening quite a bit on Panoptic.
And I like this a little bit more than Perps, because sometimes that funding rate is a little bit unpredictable. But we know that when you buy an option, be it a call or put on Panoptic and in TradFi, you're paying. So the funding rate is essentially you're paying always when you buy. Whereas when you sell, you know that you're going to receive the premiums or the funding. So this is how you're able to fund and balance the legs. Whereas if you just buy or sell a perp, you could be positive, could be a negative funding rate, could go either way.
Yeah, definitely.
So let's jump to the final trade on base. We're going to look at the best.
Was wrong on this doubly, but yes, let's look at the other one. I think
this has been a
both
hard
losers were directionally wrong. So they sold near the top, and it went down over the past day. It's also a day and a half old. So yes, it's a day and a half into a monthly trade. Please don't panic. Either one of those holders. Have the market kind of give enough time to the market so that your assumption will be realized, and then you will actually get the bullish outcome you wish. But yeah, a day into it, I wouldn't be worried.
All right. Well, I think you said that your guess for the best trade on
Also a
base
call,
is
yes.
selling a call option. So let's go take a look here. So we have a very fun trade here. This is actually a synthetic perp. So you can trade perps with options. Interestingly enough, it was opened for just over a day, it looks like, and they were kind of just sniping that price movement. So unlike everyone else, they actually bet the price was going to go down. Maybe they thought things were too optimistic in the past few days. And so at the 2,600 price, at the 2,564 price, they actually shorted a perp. And then the price correctly went down by just looks like $31 is all.
No, this is a great trade, and again, there's a fusion. The first one is that they are shorting a perp, and they are effectively controlling again $10,000 worth of capital, 2 ETH, a little bit more than 2 ETH of capital, with only $500 of requirement. So it's a 10x short perp. And they were right in terms of movement. It went down by $30. But because they had two of them, they made $60. And the fees they paid is tiny, $3. So this is, you can call this scalping, you can call this kind of day trading. But if you're into perps, you can do 10x leverage, shorts and longs. And in that case, they paid $3 out of a $60 move. We should maybe, the liquidation prices for those will likely be, I don't even think it's going to be like close to the 10% up. But yeah, maybe the data. But yeah, this is a very, very good trade. Congrats to that timing. And maybe they did it one day in the morning, and then lunchtime next day they closed it, which is great. So this is kind of the another way to trade. I don't know if the spread or multipliers were favorable or not, but it paid so much, $3 of premium by controlling $10,000 for a day. It's actually pretty good.
Yeah, I mean, so they were paying out the funding essentially on here, which for short perps, yeah, I think that's kind of interesting. I'm not sure because that means because they were short perp, so and they were paying, so it would have been a negative funding rate essentially. I would be curious how this compares to the funding 6 days ago, because normally
Yeah,
it has
I did a
positive.
quick calculation. This is about 10% funding rate annualized. So if they hold this, because you sell an option and buy an option, it compensates. Again, you fund the put that you're buying by selling a call. And yeah, it's a 10% funding rate annualized. I don't trade perps often. I don't know if it seems low, I guess, but I don't know about the real rates on like exchanges like Hyperliquid. But yeah, if you think in terms of perps, your perps trader, this is a 10x short perp paying 10% annualized fees on it, which is $3 per day on $10,000 worth of capital.
Yeah, this definitely sounds ripe for some exploration of arbitrage because this is purely a perp. The only difference here is the funding rate is paid every block. And as you see, that sounds scary, I think, to perp traders who are used to the 8 hour or 1 hour. But if you look, the funding rate, of course, is so small because it is per block. It's just really about smoothing out your payments over time. And these are very liquid Uniswap pools. So the funding rate can't really like spike up gigantically
Oh,
all
that's
of a
right.
sudden.
Maybe I'm not familiar with exchanges, but if it's an 8 hour funding rate, could there be an attack right before the funding rate, and then you kind of skew the numbers, or it's
Yes.
time based weighted? Oh yeah, how does that work?
Yeah, you can snipe before and after because they're actually implemented at the 8th hour, let's say. So
Really?
yeah, I mean, but then like markets take care of this and then they go snipe everywhere and then things, yeah. So there's always some market inefficiencies based on the market
No, but
structure.
you need dozens of traders looking at that trade to make it efficient. And as you said, it's a Uniswap. It's smooth. It's by design extremely easy to manage and handle. That's right. I love
By
the
design, it's unsnipeable, yeah, because you're
exactly.
every block. But
And if it were a sniper for one block, you cannot. There's a limit as to how much they can increase the funding rate, which is kind of, you need to trade. You need to have like multiple things happening at once. Yeah, you would need to trade against all the liquidity in Uniswap as well, not just ours. So yeah,
yeah, so basically the funding rate's very dependable here. You get, they paid $3, they made 60. Sounds like a good trade on their bet here. So why trade perps when you can trade perp options? Because perp options is like a superset. It includes perps. It includes perp options. Perps only include perps. They don't
that's true.
include perp
It's
options.
like,
So
again, it's um, I'm a physicist, but like the Fourier transform, you can decompose any function into basic components, and again, options are like almost the individual items of this. And maybe someone also asked on Twitter, but do we have historical tick data available for these perp options? So this is also something that we do research, we do back tests. We haven't done anything on perp, so it's probably should be something on our timeline, but that is easy to get. It's all open source. It's all publicly available on Uniswap and kind of even Panoptics. Like, we share our notebooks. So yeah, now that I think of it, we will likely have a perp option uh, research bite, I guess, going out in the next few weeks. But yeah, this is definitely something that we also don't know. It's a new market. new type of options, new type of instruments. We want to know, so we do the research ourselves. So yeah, this is the research team, research team's page. Yeah, if you want to comment on that as well.
Yes. So for perps, we don't have any backtests yet. So as you mentioned, that is a hot topic that we're looking to cover. But for perp options, we do have a lot of backtests for calls and puts, and even I think straddles and strangles are coming up next. And so you can check these out. Any of these research bites, panoptic.xyz/research, where we actually go over the backtest. For example, this one was looking at the premiums from selling calls, 10 delta calls as a perpetual option. And then we even link the code here. Let me see if I can find here. Yep, right. C code here. If you click here, you're going to see like Python scripts. It's all public. Backtesters. It uses the Uniswap data to calculate the fees to backtest over. And it generates all these wonderful results that you can go and test out your strategies if you're curious. So check it out. Of course, ask us any questions in Discord or Telegram if you.
And actually, let me showcase a sneak peek. The migrator app is on the way, but one thing that we got diverted to is the in-house back testing. So again, the back test is somewhat intensive, and you have to look at all the tick data, and overall, you need off-chain capabilities for sure. But we were able to kind of leverage the Uniswap infrastructure and still show backtests on on Panoptic, even though it was not on Panoptic if you want. So this is a real, this is the biggest one I could find, but a real Uniswap position, whatever, token ID 921400. It's $20 million worth of liquidity deployed right here between this range. It's in range. And we can now look at the premium, which is over the past month, nothing was there because there was no deployment. We see also how much fees they collect. In that case, they're earning 1.3 million in fees over the past week, past 2-3 weeks, but yeah, maybe past month. But now we have the ability to show this. Now we can actually allow you to choose any range, create a multi-legged positions even, and have this is part of the position builder, have an idea of what the fees would look like looking in the past. So this one position definitely is on the bigger side, but then it allows us to now also display the fee accrual rate. So even if you have a Uniswap position, you can even use Panoptic's interface to kind of get some hedging ideas, or at least some analytics out of that.
Wow, very cool. Love seeing this. Imagine if this was available for you to buy as an option. How much liquidity? And they would be making even at 1.001x on their 1 million in fees.
No, that's right. There's a lot of the ceiling is pretty high, and that user also would also be paid more if they sell. So we don't want to force anyone to move away from their current like stack. But yes, the key point is that we want to make it easier for LPs to be profitable. We want to show them all the tools they need, whether it's looking at their existing positions or helping them migrate to Panoptic or creating new positions on Panoptic. There is a lot of information that we find extremely useful ourselves that we want to also display and communicate to our users, so they can actually now look at their position, but then even that understand the payoff, understand the risks, and all of that.
And can you see, like, the current price is 25.45? So will you be able to see later, like, the mint price and then how much has changed? Because I'm so curious to see how much they've either lost.
No, exactly. It's a bit clunky. We would need. No, actually, it's there. Yes, we could go back and see when it was opened. We're leeching off the the Uniswap data if you want. They don't store the entry block. It's only stored on their subgraph. So we do all of this without the subgraph. So it's a bit more difficult. But this one position, we can see this because that range was never created before. They're the first ones to create it, and it was on whatever May 9th. If it was a range that someone else had created, it would have stopped. So, anyways, there's a few key things, but yeah, we could even exactly. We can now know how much this user has exposure. We don't know about their hedging, their other positions. So what may look like a big loss to us, for them, it's probably like something that they have more into control. But yeah, the The way you
Yeah.
manage LP positions in Uniswap could also go through Panoptic in a way.
Well, this is sweet. This reminds me of one of our favorite accounts, the well watching accounts on Twitter that kind of monitor these positions. So maybe we'll see some cool updates
Yeah,
on
and
this
again, 20
person, 'cause
million.
it's still
This is the
open.
biggest one that exists currently, and this is the Panoptic liquidity. We've seen a lot of uptick. Thanks everyone. This is great, like nearing $2 million on that pool. But the Uniswap is still big, but that big chunk is what this position is. So a lot. We're, you see, inching up. But the key point is that the existing liquidity
Be the
now,
Perp
you can
wallet.
track it, and I'd be interested to see how much fees that position earned, which is out of range. Maybe I'll do some online sleuthing to see who it is. But yeah,
Well, very sweet. Well, that concludes our stop losing, start trading, and best and worst trades for the week. Happy Friday! It's always fun to see what you guys have been up to on the options and LP platforms. We'll be back on Monday. We have these shows every Monday, Wednesday, and Friday where Guillaume teaches Rosalie, and hopefully the Panoptic intern is listening to learn how to trade options 101. And also Tuesdays is when we run our research live stream. So that's where, if you're interested in those back tests, as one user asked about, you can see our research team present live about different back tests of selling or buying perp option and perp option strategies on Panoptic. So have a great weekend, everybody. Stay tuned for our base trading competition that will be launching on Monday. So get ready. You can deposit your funds in the CBBTC USDC pool. The information is on our website, panoptic.xyz. You can go there and check out the details of the upcoming competition. We had so much fun and participation with the last contest on base that we're going to be throwing this second competition. It will be going for the month of June. And so basically all you have to do is deposit $100 minimum in CBBTC or USDC or some combination of both, and then put in some trades. The best winners can win up to 4,800 USDC is the prize pool, over 5 million pips. And then do you want to announce the special prize? I'm not sure if you've announced it on this live
some
stream
people
yet.
may notice some interesting item. The price, the volume price is a custom made, high quality, premium fabric microcellular pillow that you can have with you. So maybe you want it, or maybe you don't want it. But if you're the largest volume holder, you'll receive this. Yeah, the other one, which was a plushie, was pretty cool, and I think we got it shipped, or at least it's on its way. Congrats to the winner. But yeah, this one is also, people will fight for it, I'm sure. But yeah, this is what it's going to be for the biggest volume.
Yes, if you don't like your pillow, we can burn it for you. But it has a beautiful face on it if you want to
You put
trade
an
and sit back.
NFT, you burn it, you
Or-
fractionalize the ownership, sell call options on that burnt pillow NFT. You can do the whole thing.
Yes, or if he gets liquidated, maybe burn it.
Yes, it's
Might
in
be
like
Taylor gets
in case of
liquidated.
emergency break this window type of thing. So now it's like you hear about it on the news, you burn the pillow as quickly as possible.
All right. Well, stay tuned for that. Get ready. Get your trading hats on Monday. That contest starts. Yeah. And thanks for tuning in. It's always great to see you all on this Friday to go over these trades. Better luck next week, Guillaume, with guessing the best and worst trades. We'll see what other three-legged options people throw at us.
Exactly. All right. Thanks so much, everyone. And have a good one.